Good morning, everybody. For those who don't know me, my name is Caroline Stevenson, and I head up the Financial Services Regulatory team here at Barnes Paul. On behalf of the entire team, I want to wish you a welcome and a happy new year. It is really great to be able to kick off our very first client event of 2024. So well done to all of you for being invited. On behalf of the team, we really hope that 2024 is filled with lots of adventure, good health, happiness, and also success for each and every one of you. Anyway, before we get into the webinar, usual housekeeping. This webinar will be recorded, so you will be able to distribute it to any colleagues or contacts who might find the subject matter of interest afterwards. Please, whilst we're talking, please do keep yourself on mute and make sure that your cameras are off. We won't have time to take questions during the presentation because there's quite a lot to get through, but if you have got any burning questions, please feel free to add them into the chat, and if we've got time at the end we can answer them. If not, we'll take a note and we'll endeavour to get in touch and get back to you on any of those points. So on to today. Well, I'm absolutely delighted to be joined by a number of speakers today, so thankfully it's not just myself. I'll be joined by my co-partner Jamie Gray, also the newest addition to the team who we're delighted to introduce to you. We are going to be joined by Lindsay Whelan, who is a senior associate in the team. We'll also have Lorna Stephen, who's an associate in the team, and Louise Richmond, who is our trainee. So on to today. Well, this time last year when we did our last January horizon scan, we were kind of pretty much here with a finger in the air. It was a bit of a horizon scan. We didn't really know what to do because the regulatory initiatives grid at that time had been delayed, but thankfully we received the grid on time as planned. So this year we have a bit more to focus on, and we'll kind of take the same format as we've done in all of these over the past couple of years. So as usual with these sessions, we'll do a quick whiz through of the upcoming quarter of the year, and then we'll pick out some interesting, or we find interesting, but some extra interesting ones to do a slightly deeper dive into, and that's what we'll present on today. This year, the initiatives within the grid itself are many and diverse, I would say. So there's not necessarily key themes, but like our client base, we're going to cover a number of different areas. So hopefully there's something that's particularly of interest to you and your firm and what you do. But as always, make sure you do look at the regulatory initiatives grid yourself and make sure that you don't miss something that we might perhaps not cover. Anyway, if we're going to move on to, I think we're going to flick on a couple of slides to looking back. We thought it would be useful this year just to do a little bit of a whistle-stop tour of the key initiatives that has been undertaken by the FCA in 2023. And just towards the end of last year, there was a speech which kind of set out the items that you can see on the slide as being the top achievements of the FCA in 2023. And as you'll know, at this stage in now 2024, the FCA is now into the second year of its 3-year strategy. And if you remember, the strategy focused on the 3 areas in that table: so tackling online harms, setting higher standards, and promoting competition and positive change. And so why, you may ask, is there a fourth column in the table? Well, the consumer duty has been deemed to be such a success, and there's so much that's emanated from that they're sort of promoting all of these initiatives as a sort of a standalone success. So without going into too much detail on what's happened in the past, because there's so much to look forward to in the future, there should be quite a few things that are familiar on there, like the forbearance measures that were encouraged of insurers to waive fees and excesses for sort of the cost of living crisis. There's the examples that are many that the FCA had made of some firms for non-compliance via fines. And also you'll see in there the successes of the pioneer in sustainability disclosure requirements and investment labels, which we'll come on to later in the session. However, a review of 2023 wouldn't be complete without at least mentioning the consumer duty. So I've mentioned it and I'm sure you're all fed up with it. So let's move on to something else. I'm going to pass you over now to first of our speakers today, which is Lorna, and she's going to introduce quarter 1 of 2024 and what we should be expecting. Over to you, Lorna.
Thanks very much, Caroline. So good morning, everyone. Thank you so much for tuning into our horizon scanning session this morning. So obviously we've got the Q1 slide up here, and as you'll see, there are a number of initiatives that are likely to affect firms in Q1 of this year, and some of those have already actually come into effect. I'll give you some signposts to some of the key initiatives, and then I'll go on to talk about one of them in a bit more detail. So as I mentioned, some of the changes have already come into effect with the leverage ratio reporting changes and consumer information rules in the payments accounts regulations having taken effect from the 1st of this year. You'll also see there in the second column, we've got the amendments to the money laundering regulations, which Jamie will be coming on to talk about in a bit more detail shortly. So no spoilers there. And we also have, so the Financial Services and Markets Act established a new regulatory gateway for the approval of financial promotions by unauthorized firms. And that is coming into effect on the 7th of February, so just under 3 weeks away there. We've also got the consultation on funded reinsurance, which Louise will discuss in more detail, and a discussion paper on the oversight of critical third parties, which Caroline will discuss in more detail. So you can see there's quite a lot on that slide. There are a number of initiatives coming firms' way in Q1, and even beyond those I've even just mentioned here. I definitely encourage you to take a look at the initiatives grid if you're interested in some of the other areas that we've got on the slide. So what am I going to discuss in more detail today? I'm going to discuss SMCR, the discussion paper that was published last year, and some interesting developments we've seen since that paper was closed. So moving on to the next slide, why am I talking about discussion paper from last year? Well, we've still not had any follow-up from the discussion paper, and it's worth reminding ourselves about the points raised in that paper in light of what might be coming down the tracks for us in 2024. So as you all no doubt be aware, and as part of the Edinburgh reforms announced late 2022, the government announced that there would be separate reviews of SMCR. So the FCA and PRA, through the discussion paper, are looking at the effectiveness, scope, and proportionality of the regime, looking at whether SMCR has made it easier to hold individuals to account, consideration of whether the regime has improved the safety and soundness of firms, and how the regulator's approach to enforcement could be enhanced to better support the aims of SMCR. The call for evidence has a slightly different lens. It focuses on the legislative aspects of the regime, and this is the HMT paper, and considers whether the regime is delivering against its original aims, whether it's competitive internationally, and whether there are any specific aspects of the regime that aren't working, for example, reading across legislation and the regulatory rules and scope of regime and any lessons learned that can be implemented. The regulatory initiatives grid doesn't really give us a lot more detail on when that further consultation paper or whatever the follow-up, whatever form the follow-up takes is due. We are aware it's due to be published in 2024, and there's a suggestion that there might be some engagement with firms formally with the regulators between April and June of this year. So it's a bit of a wait and see on that point. But in the absence of a published paper, what are our predictions for what might be in there? So the tone of the discussion paper and the call for evidence suggests that there's both support for the overall approach of SMCR and that a number of positives have come from the regime, such as senior managers better understanding and being able to articulate their responsibilities. It seems that any consultation paper will be focusing on the kind of practical day-to-day improvements to the regime rather than introducing wholesale changes. But another thing that might be on regulators' minds is that there hasn't actually been a lot of enforcement actions under SMCR yet. And it is interesting that the regulators' discussion paper specifically sought views on enforcement under the regime. And that might be because it's more of a preventative regime and the checks on senior managers prior to them gaining approval is working to prevent bad actors from entering the sector in positions of responsibility. But that's not to say that there hasn't been any enforcement. The PRA published only last week its decision to fine the former chief executive officer of Wylands Bank almost £120,000 for breaching 3 conduct rules, which I've set out on the slide, between 2016 and 2020. So the PRA found that Mr. Hunter had failed to take reasonable steps to ensure that Wylands had adequate systems and controls to identify, assess, and manage connected parties' risks in relation to large exposures. And it didn't have a formal and appropriate document retention policy in accordance with the record-keeping obligations set out in the PRA rulebook. So the case raises a number of interesting points, but the PRA was particularly concerned with an SMF individual holding multiple senior manager functions and whether that could cause harm in itself. So in the Wylands case, Mr. Hunter was both SMF1, which is Chief Executive Officer, and SMF4, which is Chief Risk Officer. And there was a suggestion that this could have blurred the lines and might have impacted on the internal risk function's independence to manage regulatory risks. So as I said, we haven't had sight of a consultation paper yet, and we will need to wait and see what's in that, but it will be interesting to see whether the Wylands case has any influence on any proposed amendments to SMCR. And we do hope that that paper is coming in Q2, fingers crossed. And so with that, I'll hand you over to Jamie, who will be covering the upcoming amendments to the money laundering regulations.
Thanks, Lorna. So it was all over the news last year, but really for a while now, politically exposed persons, or PEPs as they're known, including British politicians, have criticised the way the law has been applied to them more stringently due to concerns about potential misuse of their prominent positions and using the financial system for money laundering. And PEPs, along with their families and close associates, have had to face heightened scrutiny from financial gatekeepers like banks, investment firms, and payment institutions. And the criticism has centered on excessive due diligence and ongoing monitoring requirements, exemplified by the well-publicized way in which Coutts exited Nigel Farage as his customer last year, although it's unclear whether he became a customer again. But more than being a source of added friction for the elite, there are concerns about inappropriate or perhaps politicized rule application, given the level of discretion that firms have to apply these rules, resulting in individuals being unfairly excluded from financial services. So there's a real concern there. And in December, the government introduced a statutory instrument amending the money laundering regulations 2017 for domestic PEPs, which entered into force a week ago on the 10th of January. And this fulfills the commitment in FSMA 2023 to categorise domestic PEPs and their close associates as inherently lower risk than non-domestic PEPs when firms assess their treatment. And while these new requirements had been part of FCA guidance since 2017, it's only now that they've been codified into law to address any lingering concerns. So what does that mean? Well, regulated firms will need to review their risk assessment procedures and apply a lower level of enhanced due diligence to domestic PEPs, unless, of course, other risk factors are present. The FCA has launched a review of the treatment of PEPs, and so the key milestone is that it's expected to report by the end of June this year on whether its guidance remains appropriate. And I think I'm passing you over. Who's taking funded reinsurance?
That's me, Jamie. Thank you.
Thanks, Louise.
Thanks, Jamie. Good morning, everyone. Today I'm going to be focusing on the consultation paper that the PRA published in November last year. The paper proposes expectations for life insurance firms engaging in or holding funded reinsurance arrangements as cedents. The PRA believes that there are significant risks arising from the increased use of these arrangements, such as the concentrated exposure to correlated credit-focused counterparties. The PRA has emphasised there's a need for prudent risk management and collateral policies to protect against this increasing exposure. The PRA's consultation paper is accompanied by the draft supervisory statement outlining ongoing risk management, the modelling of solvency capital requirement, and the structuring of the funded reinsurance arrangements. So the PRA proposes that firms should set limits to their exposures to the funded reinsurance counterparties beyond the risk tolerance that was set out in Supervisory Statement 120. Firms will be expected to apply an immediate recapture metric which measures the impact on a firm's SCR where all ceded business is recaptured, ignoring the likelihood of the recapture or the impact of any mitigating action. PRA is also proposing firms set internal investment limits to ensure that firms aren't exposed to a single counterparty whose failure would threaten their business model. Firms will also be expected to have additional limits to consider concentration risks based on the simultaneous recapture from multiple counterparties and an aggregate limit on a firm's own need for a diversified asset strategy. PRA proposes that firms should have clear collateral policies in place as part of their risk management, which are closely linked to their risk appetite. This will provide firms with a reliable estimate of the impact of recapture and ensure business models can survive. Firms are increasingly accepting illiquid assets to back collateral. Collateral policies are therefore expected to include details on credit risk, credit assessments, valuation methodologies, matching adjustment eligibility monitoring, SCR modelling, and the investment management approaches on recapture. So in terms of the recapture plans, the PRA are proposing that firms document a recapture plan to demonstrate they can survive any single recapture event and multiple recaptures from correlated counterparties, as well as make robust cost forecasts of recapture plans under stress conditions. PRA proposes new expectations for SCR to address the known uncertainties and provide a framework to ensure the internal model adequately reflects the risk. Firms will need to clearly articulate their data choice for setting PD assumptions and be able to calculate PD in both base and stress conditions. Firms will be expected to stress the underlying liability cash flows using the same approach used in the main modules of the internal model when calculating a stress best estimate liability value. Additional expectations are proposed on the recognition of the loss mitigating effect of collateral, including a requirement on firms to stress underlying collateral portfolios on a look-through basis, considering key market risks. PRA proposes to set expectation that firms assume that assets and liabilities are recaptured outside of the matching adjustment portfolio, unless firms can actually demonstrate this inclusion would result in non-compliance with the matching adjustment conditions under both base and stress scenarios. If this is demonstrated, the PRA proposes that the calculations consider the rebalancing and trading activities necessary to achieve this compliance. So when it comes to entering into funded reinsurance arrangements, the PRA has said firms should have a quantitative risk assessment process that reflects a range of risks. This would include internal approved contractual risk appetite statements setting out the maximum acceptable loss for each individual contract. So what next? The consultation period is open until February 16th, and then the PRA is proposing to implement these expectations during Q2 of this year. So watch the space. I will now pass you back to Caroline to discuss critical third parties.
Thanks, Louise. So big changes afoot in the insurance industry. Anyway, I get the pleasure of telling you the latest on critical third parties, which are in the process of being brought into regulatory supervision. So for those not familiar, CTPs, as I'm going to refer them for the rest of this, or else my segment will be 3 times as long. So they're those service providers that your firm might use that are really critical to the firm, and those where if they were to fail, you'd feel a huge impact on them. So think things like your platform or your IT cloud provider. In fact, we're finding that certain providers of cloud services are really prevalent in the market and used by multiple firms. So if that were to fail, it wouldn't just impact your firm, it might impact multiple firms and therefore millions of customers. In fact, when all of this kicked off, it was noted that in 2020, I think 65% of UK firms used the same 4 cloud providers. So you can imagine what would happen if those 4 cloud providers happen to fail at the same time. Almost 3/4 of those firms' customers would not be able to access their financial products or services. So it would be a complete disaster. Anyway, currently, as a regulated entity, it's your firm's responsibility to put measures in place to ensure the continuity of services of those providers, like the cloud providers. And this is done, as you'll be aware, through your contract and ensuring that all of the required regulatory requirements around sort of outsourcing and resilience are all within that. What the new regime in respect to CTPs does, it's to start of try to ease that regulatory burden slightly by giving the regulators a direct line into those unregulated service providers. And whilst this has been bubbling for a while, the latest update on this was released on 7th of December last year, when the Bank of England, the PRA and the FCA jointly launched CP 2330, which focused on operational resilience and more specifically critical third parties. And so this also all emanates, as with most of the changes of late, from FSMA 23, and that provides HMT with the right to designate a service provider as a CTP. However, it's not an absolute right, because within the statutory provisions, HMT can only designate or only exercise this power if, in their reasonable opinion, a failure in or disruption to the provision of the services that the third-party provider provides to firms and FMIs, either individually or where more than one service is provided taken together, could threaten the stability of or confidence in the UK financial system. So it's not going to be all providers. It's really going to sort of hone in on those sort of really critical ones. And within FSMA 23, it's within section 312L, which sets out the statutory test for this. But before designating a third-party service provider as a CTP, HMT must regard to certain criteria, and that is the materiality of the services that the third-party provider provides to firms and FMIs, and also the number and types of firms and FMIs to which the person provides services. So it's all about how important those services are and a bit of concentration risk. So because of that and the specific criteria, the regulators believe that only a small number of CTPs will be caught by the statutory test. So nevertheless, the consultation then goes on to cover the changes that would be made to the PRA and FCA rules, as well as the requirements the Bank of England places on FMIs. And so within the consultation, we're seeing the regulators jointly seek views on the process of how they would go about identifying critical third parties and recommending them for designation as such. And this would look at things, as I've mentioned, like materiality, the level of concentration risk, and also the impact that disruption would have on the sector should that provider fail. The consultation then goes on to set out 6 fundamental rules that would apply to all services that CTPs provide to regulated firms and FMIs. And these would, as if we needed it, it would form a new chapter within the handbook, and it would be called the CTP Fundamental Rules chapter, or I think I can't remember, FRC something, so another acronym. And then these are quite similar to some of the existing FCA requirements that fall to firms, and it's all was focusing on integrity and sets out the level of conduct that you're required, and it uses similar languages like due care, skill, all of that good stuff. The consultation then sets out 8 operational risk and resilience requirements that must be complied with by CTPs. And these focus on a lot of the things that you'll be already familiar with through the operational resilience requirements, like testing and mapping, and the requirements have playbooks, etc. There's also planned to be various information requirements by CTPs, which would include things like annual self-assessments that they'd have to provide, and also kind of giving the FCA the right to get that information directly. And also, like any other firm, there is the good old reporting requirement. So actually, you need to, for specific kind of issues or service disruptions that may adversely affect the services that the provider is given to clients or their firms, that would need to be notified to the FCA so that they can monitor this and kind of actively assess the risk. We're expecting quite a few more documents coming out of the consultation from the regulators, which is setting out more detail on this. But the consultation closes on the 15th of March this year, so there's not long to get your views across. And with that, the regulators jointly plan to publish the finalised requirements within H2 of this year. So later in the year, we should get the requirements. There's no indication of when this would come into force, but I suspect there might be quite a lot to do. So as a regulated firm, what does this mean for you? Well, I would say keep a keen eye on progress. The regulators will likely lay those rules the second half of this year, and that will definitely affect your relationship with certain suppliers. I would imagine that your contracts and procurement processes might need to be updated in light of the changes. And just to end with one word of caution, the consultation paper does reiterate that firms shouldn't rely on the designation of a CTP under FSMA to confirm that that provider is inherently more resilient or safer or more suitable as a provider than a non-designated party who can provide the same services. So that's one to watch. Just because a CTP is a CTP, it's not the best bet in order to provide those services. So that is a very busy Q1 finished. I'm going to pass over to Jamie, who's going to introduce Q2 and what we should expect.
Thanks, Caroline. Yeah, so on to Q2. There's plenty that we could touch on here, like the PSR's feedback on its APP scam prevention, biometric guidance, and the final report on the market review of card scheme and processing rules. This is just a snapshot into what we think is particularly relevant to our client base, but just keep in mind that none of what we're covering today is happening in isolation. So for this quarter, firstly, I'm going to cover PRIPS and the new UK retail disclosure regime. Lorna will then take us through Solvency II developments and matching adjustments, which is essentially increasing investment flexibility for the types of investments that can be held. And then it's over to Lindsay to talk about SDR, the sustainability disclosure requirements and investment product labels, which have been hotly anticipated. So starting with PRIPS, we can move on. Thanks. So the UK's retail investor disclosure framework was largely inherited from EU legislation, and it includes this packaged retail and insurance-based investment products regulation, or the PRIPS regulation, and has done for the last 6 years since January 2018. And despite its significance, this regulation has been referred to as poorly conceived, poorly drafted, ill thought through, with unintended consequences, which is a pretty damning appraisal, but probably justified. First, though, some background. The regulation applies to indirect investments where returns are tied to the performance of other assets or exposures. So it could be shares, real estate, or reference rates without actually owning those underlying assets. So examples of a PRIP might be a collective investment scheme, an alternative investment fund, structured deposits, and derivatives like options, futures, or CFDs. And the critical central component of the PRIPS regulation is the Key Information Document, also known as the KID, which is a standardized 3-page A4 document given to retail investors before investment. But that one-size-fits-all approach of PRIPS has created issues, as different products understandably have unique features requiring non-standardized fact sheets or otherwise limiting retail activity in what should be vanilla investments. So responding to those challenges, the government's Edinburgh reforms announced in December 2022, which we covered last year, gave the FCA authority to replace the PRIPS regulation with a more tailored approach. And it's expected to be revoked when the FCA introduces new rules. Recently, the Treasury released a policy note in December last year outlining the UK's new overarching WYSI retail disclosure framework, and including alongside that the draft Consumer Composite Investment Designated Activities Regulations, which will be the regulations that are set to replace the existing PRIPS regulation. And the new regulations will allow for a regime that applies only to more complex products, suitable to the UK's capital markets, and that enables informed retail investor participation in those markets. The new designated activities regime under FSMA 23 will feature too. It's proposed that those who engage in manufacturing, advising on, and offering consumer composite investments, or CCIs, will fall under the FCA's remit, regardless of whether or not they're authorised. It's also been confirmed that the government intends to include UCITS. Previously, under the PRIPS regime, UCITS have been exempt from the KID disclosure requirement because they have their own equivalent. But this is going to be included going forward for consistent disclosures. In terms of key milestones, we've got at the bottom there, the FCA is expected to commence consultations in the first half of 24, with a policy statement anticipated in the second half in this year as well. And with that, I'll hand you over to Lorna.
Thanks very much, Jamie. So as Jamie mentioned, I'm going to be talking about the reforms to Solvency II implemented by Solvency UK and the matching adjustment. So on 28th September last year, the PRA released its second consultation paper on Solvency UK, the reforms Solvency II framework for the UK insurance market. So these reforms aim to relax some of the requirements relating to the use of the matching adjustment by insurers. With the enactment of FSMA 23, the PRA now has the authority to establish comprehensive rules for the matching adjustment, allowing changes to matching adjustment and fundamental spread calculations. Now, given that this is such a technical and perhaps more actuarial area, the consultation paper I've mentioned there is pretty substantial. So what are the key takeaways for impacted firms? So the first takeaway I'd like to draw out is the increase in investment flexibility offered by the proposals. So the PRA proposes to increase the range of investments that firms may hold in a matching adjustment portfolio by providing a framework to permit inclusion of assets that don't have fixed cash flows. This requirement for the matching adjustment assets to have fixed cash flows stems from Article 42 of the Solvency II regs and only provides limited exceptions to the rule. So in its November 2022 statement, the government set out that additional assets that could be included should have highly predictable cash flows. But what is highly predictable? So the PRA proposes that in order for these additional assets to be included in the portfolios and not to give rise to material risks of the quality of the matching, they should meet certain criteria. And those criteria are that the cash flows are contractually bound, and failure to meet the contractual terms is a default event. The contractual bounding applies to the timing of the cash flows. And then the final point is that the contractual bounding applies to the amount of the cash flows. And whilst this is an expansion of the range of investments which can be held within a matching adjustment portfolio, and that is definitely a positive for some firms looking to use this, there are still restrictions on this, and these highly predictable cash flow assets may only make up a maximum of 10% of a firm's matching adjustment portfolio. The second point I wanted to pull out, and it sort of echoes the first, is the one around increasing the first point on increasing investment flexibility. The PRA is also proposing to update the rules around liability eligibility requirements. So whilst the matching adjustment rules regulations will be issued by the government and therefore specify some of the rules, it will otherwise be for the PRA to make these additional rules. So here the PRA proposes to extend the list of permitted underwriting risks to include recovery time risk. So this is the risk that income protection policyholders take longer to recover from sickness than is assumed in the insurance firm's projections. The rationale for including recovery time risk is that the cash flow profile is similar to that of in-payment annuities, and so they're suitable for inclusion within portfolios where they're replacing longevity risk. And the final point I wanted to pull out, and might not be that surprising given I discussed SMCR in Q1 section, is that the matching adjustment consultation paper also proposes that a senior manager attests to the PRA on the sufficiency of the fundamental spread and the quality of the resulting matching adjustment generated by the assets in the matching adjustment portfolios. The proposed attestation would be made on an annual basis for each matching adjustment portfolio and on an ad hoc basis where there is any material change in the firm's risk profile. The existing senior manager responsible for the production and integrity of the firm's financial information and its regulatory reporting must also be responsible for this new matching adjustment attestation and would likely be a CFO in practice. The attestation would be required to be made using standardized language, and firms must also implement a policy and the related systems and controls in order to support this attestation being made. The fact that there is also a requirement to provide an ad hoc attestation on material changes to business could prove cumbersome for some firms from a practical perspective, so it will be interesting to see how this is reflected in the final rules and guidance. The consultation period for this paper ended just at the start of this year on the 5th of January, and final rules and guidance are expected to be published in Q2 this year and to come into effect at the end of June. So clearly this isn't a lot of time for firms to prepare, so I would hope that the final rules are published towards the start of Q2 rather than the end. I'll now hand you over to Lindsay, who's going to be talking about the sustainability disclosure requirements.
Thanks, Lorna. So I'm going to round up Q2, and that's going to be the first implementation date for new rules set out in PS 2316 and the sustainability disclosure requirement and investment labels. This sets out the final rules and guidance for relevant firms to comply with to help consumers understand to what extent investment products are sustainable. The implementation timeline is phased between the 31st of May 2024 through to the 2nd of December 2025, so it's important to go through each of the requirements and understand exactly when they come into effect. So currently, the use of sustainability terms is very subjective and inconsistent, and there's no objective or evidence-based criterion on which to assess sustainability claims. There's increasing demand from customers that their money does good as well as delivering a return. And that's one of the reasons the FCA has acted in this area. The final rules fall into 6 different categories. And one important point I want to make at the start is that certain elements impact all FCA authorised firms to some extent. So this isn't something that just impacts investment firms. So there's 3 different types of firms in scope broadly. So firstly, all FCA authorised firms to the extent that they're making sustainability related claims. The second is in relation to asset managers who are using the investment labels and disclosure naming and marketing rules. And the third is distributors who also have a role to play in bringing these disclosures to the market. So the 6 new requirements or categories, the first is in relation to anti-greenwashing. So this is to reinforce that any sustainability related claims should be fair, clear, and not misleading. Draft guidance is included within the policy statement, and final guidance will be published in May 2024. So I don't think we're anticipating any big changes there, given they come into effect in May 2024. The second is in relation to the labelling. So there's a creation of 4 different labels which can be used for investment products. So this is an election to use the labels, so it's not something that's mandatory. But if firms do want to use the labels, there's sustainability impact, sustainability focus, sustainability improvers, and a 4th category of sustainability mixed goal was added by the FCA following responses. So as the name suggests, that's for investments that cover different elements of the previous 3 categories. So electing to use one of these labels means that you must meet and monitor the requirements for doing so. One example, we don't have time to go through them all, but is that 70% of the gross value of the product's assets must be invested in accordance with its sustainability objective. So it's really important that there's good data monitoring, and this is evidence-based. Turning now to the naming and marketing rules. So this is separate to the decision to use labels. But if you want to use one of the sustainability terms, which is set out in the new provisions of the ESG sourcebook, there's new rules applied to the use of such terms. This is to ensure that they're accurate, and general and vague references to being green or net zero or any of the other protected sustainability terms will not be permitted. In relation to consumer-facing disclosures, despite consultation responses requesting that disclosures be made through an existing document, such as the key investor information document, which was touched on earlier, the FCA stuck with the requirement for it to be a standalone disclosure and in a prominent place, which is going to require the drafting of an additional document. There's also detailed information to be made available in relation to pre-contractual, ongoing product level and entity level disclosures. This is targeted more towards institutional investors and to consumers seeking more information. That's also an important one to look through in terms of the implementation timeline, because some of them need to be made available on demand and others have to be prepared, I think, within 12 months. Finally, in relation to distributors, the rules also impact there, and there's an important role to play in making sure that the product level information and labels are available to consumers. So in terms of things to think about and next steps, we'd recommend a literature review for references to anything green, environmental, and the other protected sustainability terms. There's much stricter requirements here now, and it's really a case of substance over style. For certain firms, there's decisions to be made. Do you want to use the labels, and how will that be managed from a commercial and compliance perspective, and managing the ongoing data and monitoring of it? In terms of implementation, as I mentioned, there's a preparation of new disclosure documents and working with your distributors and platforms to make sure that these are available. Just one or two final points to note. It is still a work in progress to some extent. So the overall idea is to level the playing field amongst the services and products, but they're not quite there yet. So for example, overseas funds won't initially be in scope. So there'll be more coming to look out for. And just on the note of overseas funds, if you also operate in Europe, you'll have been working with the Sustainable Finance Disclosure Regulations. This is a different regime and more focused on disclosure rather than labeling, but the policy statement includes quite a useful information mapping between the sets of requirements, the SDR, and the disclosure regulations. So that might be worth looking at. I'm going to turn now to Q3 and what we're going to cover here. So traditionally, summer is sometimes a quieter time for regulatory deadlines, although consumer duty kind of bucked that trend. But overall, the quarter does look relatively quieter. However, there's still a couple of things to look out for. So there's a policy statement coming on the ring fencing regime for banks, and there's consultations in relation to payments and e-money institutions, rules for stablecoin, and the UK prospectus regime. There's also new rules coming into effect for derivatives reporting regime. In terms of what we're going to go through, I'm going to go through consumer duty and the application to close book, amongst other things, which will come into effect in July 2024. And then Jamie is going to take us through the consultation response on crypto. So turning to consumer duty, I'm sure you're all very familiar with it, and maybe one of the biggest significant changes last year was consumer duty. A huge amount of work's already been carried out across the industry to embed the consumer duty rules and principles. I will focus on 2024, but I just want to briefly cover the 6 months period since the implementation of consumer duty and the activity that we've seen from the FCA already. So in November, Nisha Arora delivered a speech emphasising the importance of continuing the momentum and consumer duty not being one and done. There was also a reminder, if we needed it, that's a top priority for the FCA. This was further evidenced by the Dear CEO letters, which came thick and fast in Q4. Wealth managers and stockbrokers in receipt of their Dear CEO letter were told in no uncertain terms about consumer duty expectations and the failings the FCA had seen in that part of the industry. This was followed by another CEO letter issued in conjunction with a consultation for advisor firms with a focus on polluters paying in the context of having sufficient financial resources to protect against the risk of harm and meeting potential redress liabilities. So essentially too much was falling to the FSCS because firms weren't holding enough capital to compensate those liabilities. December saw a further Dear CEO letter issued to platforms and to SIP operators in relation to the margin being retained on interest and client cash balances. This letter also specifically mentioned consumer duty, and the FCA gave clear instructions to respond with confirmation and information about the request by the end of January, so 2 weeks' time, and to have made any necessary changes by the end of February. So a really tight turnaround given the letter was only sent in December. So having everyone clear of the priority that consumer duty is, I'll turn to the board reporting requirement. So there's every 12 months, the board must review and approve an assessment of whether the firm is delivering good outcomes. So if the board hasn't already done this since consumer duty came into effect, there's 6 months in which to do this. The report should include the results of monitoring being undertaken and any evidence of poor outcomes. It'll also be a key part of the review by the FCA to assess a firm's compliance with consumer duty. So it should be thorough and evidence-based in the context that the FCA will be reviewing it to assess the compliance. So the 31st of July 2024 sees consumer duty also applying to closed books. In some ways, it might be easier because consumer duty is embedded across the firm and well known, and there will be certain elements which won't apply to the closed books. So for example, in relation to target market. However, in other ways, we know that closed books are complicated by a couple of factors, and I know work should continue in earnest to ensure that the changes are implemented in time. So I just wanted to highlight a couple of additional factors that might be complicated for closed books that will be being worked through. So in the context that some of these are aged products and might have been closed for a number of years, there's a review, there'll have to be a review to ensure that any T's and C's are fully written out and available to clients, and a review to consider when they've last been updated and how easy it will be to update them to make any changes to comply. Also, the review of the product life cycle and a review of the features, literature and process, which may not have been carried out for some time, depending on how long they've been closed. It might be complicated by historic systems with hard-coded templates and features, making it more difficult to make changes. And if these books have been sold along the way, it might be more difficult to have subject matter experts who are able to help. Just one or two final points to note in relation to the fees and benefits of the closed book products. Historically, we know that some of the older products had higher fees and margins, and the extent to which that's changed over the years, or whether it's still appropriate and offering value for customers. As I know, I'm sure everyone's well aware of the value assessments as well. And the final point I wanted to mention was in relation to data. So a lot of the products will have been made available which in a time that wasn't conducive to data reporting and monitoring. So there might be complications in order to set up that framework, and it'll have to ultimately pull through for the board report, which depending on the timings might not be for next year if that's included. I'm going to hand over to Jamie now to take us through crypto.
Thanks, Lindsay. So on to the exciting topic of crypto assets. It had a lot of attention last year from lawmakers and regulators involved in shaping the future of what crypto asset regulation looks like. We've already had several key initiatives so far, like the money laundering registration regime, the extension of the financial promotion regime to include crypto assets, and initiatives like FMI sandboxes have also been introduced. However, an essential aspect yet to be determined is how regulation will authorise crypto businesses. And in 2022, the government confirmed its intention to regulate fiat-backed stablecoins used for payments, and FSMA 2023 enabled the legislative framework to make that happen, and that's referred to as phase 1, which sets the state for regulatory implementation. But what I think is more interesting perhaps and impactful is that in early 23, the Treasury also consulted on proposals for the regulation of a broader range of crypto assets, including Bitcoin and algorithmic stablecoins, and that's known as phase 2. Instead of creating a bespoke regime, the Treasury opted to integrate crypto assets within the established FSMA 2000 framework to maintain a level playing field between crypto asset firms and traditional finance.
Jamie, so sorry to interrupt. There's a bit of feedback coming when you're talking. Do you want to do a bit of fiddling with your mic?
Oh,
See if that helps.
yeah, sure. Hang on, let me try a different.
Sorry, everyone.
Is that
Bear with us.
better? No.
It's odd because it didn't happen last time you spoke.
Any better?
Yes. Continue.
Weird. Did you get the start, or should I?
Yeah, you got it. It was just
It's just annoying.
a bit.
Okay. So we're talking about the activities involved in this framework. Proposed are issuance, operating exchanges, and some intermediation activities like dealing and arranging deals. But perhaps importantly, hopefully is the sound working? No.
Sorry, it's just got quite a lot of feedback. let's try now. It's got a bit quieter.
Maybe if I talk slower.
No. Let's skip over your bit and then we'll try and come back to that if you've got another microphone option potentially.
Yeah.
Let's see. Sorry about that, everyone. That Jamie's segment was actually very interesting. So, but hopefully we'll have time to come back to that if we manage to get his microphone working. So we'll skip over just now into Q4. So we're heading towards the end of the year here, and there's quite a lot here on this screen that you've already seen, but you'll see that there's a box at the bottom, which is basically our catch-all box for things that we've been told are due to happen at some point within 2024, but we don't necessarily have a timeline for them yet. Excuse me. So I get the kind of, I'm going to kickstart this quarter by talking about the first one, the Bern Financial Services Agreement, which I find really interesting. And I think this is part of the new sort of pioneering post-Brexit world that is hopefully going to help the financial services sector grow and expand and remain competitive. So you might not have heard of this, but the recently established Bern Financial Services Agreement basically grants UK and Switzerland Swiss financial services enterprises greater accessibility to each other's domestic markets. So under this agreement, both nations will reciprocally acknowledge the domestic law and regulations of the other. And this agreement is being hailed as the most ambitious and comprehensive outcomes-based bilateral agreement in financial services. And it is definitely a global first for the UK in terms of breadth and depth. So what does this do? Well, effectively, it addresses regulatory barriers to cross-border business, not just market access. So in doing so, it removes the sort of usual line-by-line equivalence assessments, and it employs an outcome-based system of mutual recognition. So as you know, we're outcome-based regulation, and we're kind of moving more towards that. And this recognizes the sort of principle that if a customer is receiving the same sort of good outcomes in that jurisdictions, then that's fine. And because of this outcomes base, it can adapt to regulatory changes because it's got the agreement's got these cooperation mechanisms in place to manage. So what does this mean? It means it's actually going to be far easier for firms to navigate the cross-border between Switzerland and the UK. And in practice, for the UK firms, this means that the firms looking to operate within Switzerland wouldn't have to follow Swiss rules if the UK rules achieve the same outcome as the Swiss rules. So basically, firms could operate in Switzerland whilst complying with UK regulatory requirements rather than having to comply with Swiss regulatory requirements. And Switzerland and the UK are not within that European Union area, so the government feels that this agreement will ensure sort of frictionless cross-border provision of financial services. And depending on the ease of operating this service, depending on the service that's being provided, there's certain things that should be borne in mind, but it's definitely not all blanket approach. It's not all financial services at the moment. So this agreement, as I said, it's the first of its kind, and the process to implement it has not been taken lightly. I know that a huge due diligence exercise was undertaken by both jurisdictions on each other's financial frameworks. And through this exercise, as I said, not all financial services can now be traded freely. So as a concept, only those financial services where the due diligence has revealed that the two jurisdictions achieve comparable goals or outcomes by the two regulators in terms of protection of investors, market integrity and financial stability will be able to be passed through freely. And this type of regulation is known as deference-based supply of financial services. Basically, you defer to the other regulator in terms of what that entity is having to comply with. So at the moment, the agreement recognises equivalence in areas of banking, investment services, insurance, asset management, and financial market infrastructure for sophisticated clients. And it's got some really good benefits, particularly for those in investment banking and wealth management, and also insurance. So what's the next steps for this one? Well, following its signature, the agreement must now follow both parliaments' kind of normal process before it can be ratified. And so it's a case of wait and see at the moment, and we will then hopefully hear from the regulators in terms of the practical implications and how that's going to be fully implemented into the current UK regime. Over to Louise now for a quick run through of vulnerable customers, and then hopefully back to Jamie if his microphone's working again.
Thanks, Caroline. So as Caroline mentioned, the FCA is going to be conducting a post-implementation review of the guidance for firms on the fair treatment of vulnerable customers. They plan to test the effectiveness of firms' implementation and how this is impacted on the outcomes for vulnerable customers. The FCA are looking to conduct the review in 2024 with the aim to publish a report by the end of the year. So this section really serves as a reminder of the 2021 guidance and the FCA's expectations of firms in advance of the review. So if we look back at the guidance set out that firms should understand the needs of the target market and their customer base, make sure staff have the right skills and capability to recognise and respond to the needs of vulnerable customers, respond to needs throughout product design, flexible customer service provision and communications, and finally monitor and assess whether they are meeting and responding to the needs of vulnerable customers and make improvements where this is not happening. A year on from this guidance, in 2022, the FCA published a Dear CEO letter. This focused on the need to work effectively to understand the changing pressures on consumers due to the cost of living crisis, set out expectations for firms working with customers who have been driven into financial difficulty and therefore have become vulnerable. Some of the examples they set out were provide customers with an appropriate level of care and support, give borrowers in financial difficulty the appropriate tailored forbearance, support borrowers showing signs of financial difficulty by helping them access free debt advice, and ensure that any fees levied are fair and do no more than cover your costs. So the letter also published the FCA's findings from their review on borrowers in financial difficulty. And some of the results, and we'll just talk about some of the results in advance of the next review. So the FCA was concerned about the quality of management information at several firms. The FCA have warned that firms should ensure that management information shared with executive committees is sufficient to give them assurance that customers are receiving fair outcomes and enable them to make strategic decisions about vulnerability. Firms are also being over-reliant on complaints data as an indicator of outcomes for customers in vulnerable circumstances. And the FCA said that firms should develop management information that goes beyond this data to gain better insight and assurance on outcomes. When it comes to capturing data on customer needs, firms should make sure that they have systems and processes in place that allow staff to record and access information that will be required in future to respond to customers' needs, so that customers don't have to repeat any information to them. The review highlighted that there was limited evidence of management information from firms that demonstrates whether vulnerability training for staff is resulting in improved outcomes for customers in vulnerable circumstances. So this will be one which will be good to watch for the next review. The FCA has not seen enough evidence of firms developing products and services across the customer journey tailored for vulnerable customers. Some firms have made progress in embedding vulnerability in their product design and review processes by making sure that vulnerability considerations are demonstrated consistently in product approval documentation. However, some of these firms are only considering a small number of characteristics of vulnerability. The FCA noted that feedback loops and management information should be used to provide insight into making products suitable, and firms should consider a full range of vulnerability drivers. Firms with well-developed vulnerability strategies are usually firms with senior leaders who are involved, accountable, and invested in this work. Firms should consider whether they have clear lines of accountability from senior leaders and how they can demonstrate vulnerability features to executive committees. The strategy for fair treatment of these customers should be embedded across all areas of the firm and championed by senior leaders. So, in preparation for the 2024 review, we recommend reviewing the findings within this Dear CEO letter in more detail. There are various practical examples which would be useful. We also suggest ensuring that your firm is fully compliant with the requirements set out in 2021 guidance. So I'll now pass you back to Jamie to hope that his mic is working and he can talk to you about either crypto or AI.
Is this working better?
Yes.
Is it?
Yes.
Great.
Yes. Yeah.
Okay. We are actually at time, so hopefully you're okay, those of you who are listening, to carry on for just a few minutes longer.
Yeah.
We're on to AI. It was sorry.
Yeah, I was just going to say, I think because for those who can stay on, let's stay on, but maybe just we can do your AI and then go back and finish the crypto just because it's working, and then people can then get it as part of the recording if that works for you.
Yeah, well, I was just going to finish off crypto very quickly,
Okay.
actually, to say that there's a couple of statutory instruments expected. We don't really need to move, but a couple of statutory instruments expected this year. Phase 1 very soon, phase 2 later in 24. And there's an ongoing discussion paper for the stablecoins phase 1 process, which is open to responses until 6th of February. And the FCA is then going to consult on the rules. So just to point out those dates. Let's move to AI. That was quick. So obviously AI, and particularly generative AI, was obviously the talk of the town in 2023, and we're expecting interest for FS firms to grow in 24. The true test, though, is going to be in how it's implemented in a way that's sustainable and compliant. And there's broad consensus generally about what AI risks are, but there are differing approaches emerging globally, and that fragmentation could pose challenges for businesses operating in other jurisdictions. I was just going to talk about a couple of points today, though, from a UK perspective, which is the government's white paper, which outlined a vision of what the regulatory framework for AI looks like. It's going to be a principles-based approach, and existing regulators will. So I'm just going to check the comments. Okay, existing regulators will, so rather than the government regulating it from a sort of single standpoint, it's the responsibility is given to existing regulators to develop specific sectoral guidelines based on 5 cross-cutting principles, which we've got on the slide there. The Bank of England, the PRA and the FCA are expected to release their guidance on applying those principles by the end of March 24. So that's one milestone for the diary. Worth noting that AI is already regulated by the existing framework, because our framework is, of course, a tech-neutral framework. So things around governance, consumer duty will be another one that will cover this concept. But it may be the case that specific rules and guidance are needed for some particular AI risks. The only other point to mention is the feedback statement, which is the most recent update from October 23 by the bank, PRA and the FCA. That's FS 223 on artificial intelligence and machine learning, summarizing the responses from a discussion paper in 22. I won't go over the responses in any detail given the time, but 2 or 3 strike me as quite useful to know about, which are most respondents didn't want a specific AI definition for FS. Most thought that consumer protection should be prioritized, especially regarding data bias and discrimination. And existing governance structures like SMC are seen by many to be sufficient, but clarification has been sought on what constitutes reasonable steps in the AI context. So unfortunately, we don't have any policy proposals or hints about what the future plans are, but it will be super interesting to watch. And I think that brings this session to a close. Thanks very much, everyone, for listening. And sorry about those audio problems. Hopefully it's now working properly. There is a recording of this that will be available after the event, but thanks again for joining. It's going to be an interesting year ahead.